Hey accounting students, this is our video lecture for chapter number 3. There'll probably be 2 or 3 videos for this chapter regarding the preparation of consolidated financial statements. And this is taking place either at the end of the year in which the parent acquires a sub or some subsequent year after that first year. And of course, we need to learn the general rules that are complex. So that's why you have open book exam quizzes, really. There's no exams, yeah? Quizzes. Use your textbook when you do your smart book assignment and also homework activities. And things get a little bit more complicated as time progresses. We need to keep track of certain amounts being accumulated and making an adjustment when we're ready to prepare those consolidated financial statements. And the key is to use a worksheet. And on that worksheet, we're combining the parent and the subsidiaries amounts and also adjusting it. So in a real life situation, what you should be doing is really looking at the last year's worksheet to see what type of adjustments were made last year. And pretty much it's going to be the same for this current year. Of course, the dollar amounts should be changing year to year. So on this worksheet, we're going to be combining the parent's revenues with the subsidiaries' revenues and the parent's expenses with the subsidiary expenses. And then take the total revenue and minus out the total expenses to get the consolidated income or net income. But we still need to make some adjustments to that net income amount. In either case, what we're doing here in these adjustments, we're determining in chapter 3 are not going to be recorded in the records of the parent or the sub. It's just used on this worksheet for consolidation purposes. Here it mentions that adjustment that we're kind of familiar with in a past chapter because probably the parent had paid more than the book value on the books of the subsidiaries' stockholders' equity. So that excess is probably attributable to some undervalued asset of the sub that now has to be depreciated or amortized each year. That could be on the parents' books, but we're going to be doing that as an adjustment, at least for the current year, only on the worksheet. And we also going to see eliminating any intercompany that, transactions that leave some type of asset or liability. Those transactions between the parent and sub have to be removed. What we need to determine is what type of accounting method the parent is using to account for its investment in the subsidiary. And that will determine what kind of adjustments we're going to be showing on that worksheet. No matter what method they're using, on this worksheet, we're going to be eliminating in the parent's account, at least again only on the worksheet, its investment in the subsidiary. So in other words, when you look at the investment account in the consolidated worksheet, investment in the sub, it should have a zero balance. And if not, that means something's not accounted for or a wrong amount was recorded on the worksheet. We're going to see there are 3 different methods for the parent to account for its investment in the subsidiary. The main one we're learning, the first one we're learning, is called the equity method. Here are the 3 methods, yeah? Equity, or maybe partial equity method, or not equity, here called initial value. Again, we'll focus on the equity method in this first video for chapter 3. And then in the second video, we'll take a look at the accounting for a consolidations. Again, all of these, eventually, we need to do a consolidation of the parent and sub. But based upon which one of these three methods are utilized by the parent will determine the amounts we put on that worksheet. And no matter which of these three methods you choose, the ending result for the consolidated financial statement should be exactly the same. Same total assets, same total liabilities, same revenue, expenses, and profit. But the adjustments we make on that consolidation worksheet, again, will depend upon which of these three methods are used by the parent. Here's a summary of those three different methods. Under the equity method, basically what you're applying is the accrue method of accounting, recording revenue when you earn it. That's including any revenue earned by the sub now flowing through to the parent. Or this initial value method where you don't touch the investment account, the asset account in the sub or of the sub on the parent's records. You keep it at the original cost. Or this partial equity method where we apply reporting the earnings of, just like here, accrue method of the sub on the parent's records, but we don't take into account any amortization of the excess value the parent had paid over the book value of the sub. That has to be factored in, not during the year, but here at the end of the year when we're doing the consolidation worksheet. In this table, it summarizes the method of applying the three methods here for accounting for the sub and its advantages. Of course, equity, that's basically accruing any income or loss from the sub on the parent's record and then updating the investment account for that. Also keeping in mind that we need to amortize any of that excess value we had paid over the book value of the sub's assets. And here it says it's a true accounting of what's happening for this equity method. Jumping to the partial equity method, you're doing the same thing here. You're accruing the sub's net income on the books of the parent, updating the investment account on the parent's records. But what you're not doing here is that adjustment in amortizing that excess value. Yeah, we had purchased the sub at. And here, I guess it says it's just easier because you're not doing that adjustment entry. And of course, the simplest method is to do cash. Basically, that's the initial value method where you set up the investment and keep it so at its original cost. And the only time you record any earnings from the subsidiary is when you're going to get a dividend from the sub. Here it mentions cash flow. Of course, cash is flowing in from a sub as a dividend in no matter which one of these three methods you do. So let's take a look at an example where we're going to be preparing a consolidated financial statement after the parent has acquired the sub. Not at the date the parent acquired the sub, but at the end of the year or subsequent years after the acquisition took place. So in this example, we're using the equity method, not the partial equity or initial value method. Also, we're preparing a consolidated financial statement at the end of the first year. The acquisition took place at the beginning of the year. And of course, transactions are happening during the year. And then at the end of the year, of course, the parent and subs will close the books and prepare their own individual financial statements. But here in chapter 3, it's our job now, after all of that takes place, to consolidate the parent and the sub's information to prepare a consolidated financial statement. So we're told information here on this screen, the initial acquisition of the sub at a total cost of 800,000 by using the stock of the parent to buy out all of the sub. So this is the book value of the sub now at the beginning of the year when we bought it. Notice we paid $200,000 more than the net book value. So we know from the previous chapters we gotta allocate that $200,000 extra to the undervalued assets. So in this case here, the current assets are exactly valued uh, at fair value. But in the case of the trademark, on the books of the sub, it's recorded at 200. But we're saying at the time we buy the sub, it's worth 220. So that excess of 200,000 we had paid, um, 8 minus 6, 200,000. Part of that excess will be allocated to the trademarks. And because a trademark has an indefinite life, we're not going to amortize this 20,000. It's just going to sit on the records of our consolidated group. And only when we think there's an impairment, which is the ending part of our chapter 3, accounting for impairments, would we write off any of this excess costs. The bulk of the costs, the 200,000 costs, is for this patent here. On the books of the sub, 320, but we think it's worth on that purchase date, acquisition date, 450. So 130 more of cost has to be allocated to the patent. And because it has a definite life, we're going to amortize that amount over this 10-year remaining life, or 13,000 per year. Now, just the opposite situation is for the sub's equipment that has a book value of 180, but we think it's only worth 150. So we kind of probably paid too much for that in the amount of 30. And if we divide this by 5 or $6,000, that's not additional depreciation. That's really going to be a reduction to the depreciation expense each year versus this 13,000 over each for the 10 years, increasing the amortization costs. Okay, so here is the balances of the sub on that date of acquisition. So on this screen is basically summarizing the same thing we saw on the previous screen. Again, here's what we paid, and here's the book value on the books of the sub, excess of 200,000, of which we allocate 20,000 more to the trademark. That's indefinite life. 130 more to the patent, amortized over 10 years. And overvalued, not undervalued, but overvalued equipment of 30 that we're going to reduce depreciation, let's see, 6,000 each for the next 5 years. So subtotal, and notice again, we need to allocate 200,000, not this 120. So there must be something else in the company we paid extra for. And then we learned before, if you can't identify any specific asset, be it tangible or intangible, we allocate that excess to goodwill. And again, we just have it sit on our records until there's an impairment, which we'll see the accounting for again at the end of this chapter 3. In this table, we see the same information. Again, if you total this up, that will be the 200,000 we need to allocate among the identifiable assets. Indefinite lives, again, no adjustment each year unless there's an impairment. And for the patent, 13,000 more amortization. For equipment, $6,000 less depreciation expense. You notice how we net it out here, and we call this 7,000 really an amortization adjustment. that we're going to see being journalized, yeah, versus the individual items here. So let's look at the journal entries that the parent company is going to record during the year under this equity method. So of course, the first journal entry is to buy that sub. So here, hmm, didn't we issue stock? Anyway, it shows cash being paid to acquire the subsidiary, debiting this investment in sub asset. And then we have journal entries for a declaration of a dividend by the sub. Now, on the parent's book, we have the right to receive the sub. And under the equity method, we're not going to record income, but under the equity method, it's a reduction of the investment. In other words, we pay 800,000, now they're just giving us back 40,000. Yeah, increase investment, decrease investment. And then looks like 7 days later, we got the money, yeah, offsetting this receivable. And then other entries we have to record during the year. Here at the very end of the year, on the accrue basis method, under the equity method, we need to um, include as income on the books of the parent. This is an income account here, credit, the amount of profit, the amount of net income that the sub had earned, thus increasing the value, increasing the cost basis here of the sub asset. Okay, so again, this is being done at the very end of the year when the year ends are closed, but before doing the consolidated financial statement worksheet. And then we also know about the amortization. Remember, there's a $13,000 additional amortization for, was it a patent or copyright, and a reduction of 6,000 for depreciation, netting out to an additional. It's almost like an expense, but here they're reducing the same earnings account here from the sub and reducing the parent's investment asset with this credit here. So after the sub and the parents have posted all of their transactions and updated their accounts. Here are the financial statements for each company, the parent, yeah, and the sub. What our job is here in chapter 3 is to consolidate both together and to prepare a financial statement, consolidated financial statement. Really just a worksheet where the numbers on that worksheet can be used to prepare a consolidated financial statement. If you take a look at this investment account in the sub on the records of the parent. So we started off buying the sub at 800,000. We accrued 100,000 of income. That's this one over here. Really, it shows up as income on the income statement here. Equity and sub earnings. This 100,000 here reduced, remember, by that 7,000 net amortization adjustment. Okay, so that would be a credit to income and then a debit to this asset account here, resulting in this 853,000. Oh yeah, we also had to reduce it by the dividend, yeah, this 40,000, reducing that initial costs, leaving this as the balance in the sub investment on the books of the parent. Okay, so we're going to be basically just adding straight across the two columns here to get a total consolidated column. But in that consolidated column, you're going to have to zero out this 853,000. In other words, a consolidated group, this whole company combined together cannot own itself, cannot own a sub because it's going to be included in the total. So this 853 has to be zeroed out in the consolidation column. Also, the equity accounts here of the sub have to be zeroed out, leaving only the equity accounts of the parent. In fact, Most of what you see, uh, most of what you see here in the parent is going to end up in the consolidated account here, except this investment account, except these items here, income of the sub and dividend to the sub. The income here is going to be accounted for when we add up the revenue and expenses of the sub. If you don't zero out this 100,000, you'll be duplicating the profit up here when we add it across to the consolidated column. Likewise, the dividend here, you cannot pay yourself a dividend. Remember, Sun is now part of that consolidated group. And any company within the group, you cannot pay the whole company a dividend. You're just moving money from one pocket to the other. Okay, so that has to be eliminated here. Just keeping the dividends that the parent pays to its shareholders. So the main thing here in chapter 3 is to learn those adjustments, the eliminations we have to record, not on the records of the two companies we're dealing with here, but only on the worksheet. So eventually we end up only with balances for a consolidated financial statement. And to hopefully try to keep things simple, I know there's a lot of detail here, so you gotta use your textbook as a reference. They group these adjustments into 1, 2, 3, 4, 5, and they label it with letters, kind of spelling out an acronym here, SAIDE. And we'll see maybe there's going to be a couple more entries with acronym letters in the next video. Let me show you the last slide that's on the PowerPoint file for this video lecture. So if you go to the PowerPoint and look at the last slide, it mentions the same letters here and give you a brief explanation of what has to be done. Yeah, this is the action you got to take. And I believe this is this equity method, this column. And here's the other two methods we had mentioned before. Yeah. Keeping in mind right now, the example we're going through is preparing the consolidated financial statement at the end of the year of acquisition. Now, there's going to be slightly different rules if you're dealing with after that first year, after the year of acquisition. Again, notice the same adjustment letters over here. So let's look at the explanations here on the slide. So the first set of journal entries called S is eliminating the stockholders' equity accounts, not of the parent, but the sub. Let me go back to the previous screen here. Again, this 200,000, this 20,000, this 440,000. Let me think now. Now, this is the end of the year. I want to eliminate the beginning of the year. Let's see, beginning right here. There's 380,000. All have to be zeroed out. And remember now, in a single column, not debit, credit, draw balance, but single column, the amounts in parentheses are not really negative, but they're credit balances. So I know I'm going to be debiting this account, 200,000, to get rid of it. I know I'm going to be debiting paid-in capital, additional paid-in capital, 20,000. I'm going to be getting rid of this beginning retained earnings. The reason why we don't eliminate the ending is because we're going to do that via reducing this net income of the sub and the dividend of the sub. Again, you can see the total here is this 440 down here, yeah? So instead of eliminating the 440, we reduce these three numbers to 0. Okay, so that's the first of the three. Oh yeah, and then when you get rid of those accounts, let me go back again. Debit, debit, debit to get rid of those three accounts. Tell me, what are you crediting at the same time? What's one of the main accounts we're trying to get rid of on the consolidated worksheet? Remember, investment in the sub on the records of the parent. This is what we're trying to reduce to zero. So after that first entry S, it's still not going to be reduced to zero, but we're going to be getting there after a couple more entries, which the next entry is this A. A stands for allocating, let's say, that excess value we had bought the subs assets at, and increasing those assets. Keeping in mind, we're increasing it by that table we had seen. Let's see if I can go back a few slides here. Yeah, this one here, yeah? You're setting up these amounts more, yeah? More, 20,000 more trademark, 130 more patent, 30,000 less equipment. Goodwill was zero before, now here, $80,000 balance. That's what we're doing in that adjusting entry A. Adjusting entry A, debiting those assets. Tell me, what are we crediting? I think you got it. It's that investment in the sub. Okay, again, trying to zero it out. Then let's see. Adjustment I. I means you're going to get rid of the current year's income of the subsidiary. We know income, really, we learned it as net income, has a credit balance. So you're going to be debiting that income for the total. Well, let's go back here. Remember we did this here? We did this entry recording income. Well, you're going to get rid of it now. You're going to reverse it. Likewise, this amount of additional amortization, right here, this debit, a net of 93. You're going to get rid of this. Now tell me why. Because you do not want to double count this net income. And it's already going to be counted when you add up the revenue and expenses of the sub with the parent. So if you don't get rid of this, you're duplicating this net over here. Okay, so that's adjustment I, getting rid of the income, net income of the sub. And then you're going to get rid of the dividend. The dividend is basically just moving money from the sub to the parent. And you shouldn't recognize any income. Likewise, you shouldn't recognize any reduction when you receive the dividend. So again, in the previous adjustment for the dividend, let's see, this 40,000 here, you can see we reduced the investment account on the parent. Well, you're going to put it back. You're going to debit that account. And you see this dividend, let's see now, dividend receivable. No, it's not really the thing I want to reverse. It's really this one right here. See this dividend declared by the subsidiary? It's a reduction to the retained earnings. Well, we're going to put it back into retained earnings by eliminating this amount here. If you have a dividend declared account, or otherwise you would use the retained earnings over here to, let's see, credit, yeah, to put it back. So that is adjustment E. And then the last one we're learning here, at least in this section, is to now report that amortization of the excess under or overvalued at the time you had purchased the assets of the sub. Okay. So here's the detailed journal entries. Again, the first one, S means to get rid of the subsidiary's stock equity accounts, stockholders' equity accounts. So you're zeroing out the common stock account of the sub, you're zeroing out the additional paid-in capital of the sub. They normally have credit balances, so you're debiting it, and you're zeroing out the retained earnings at the beginning of the year of the sub, not the end, yeah, but the beginning. Again, the changes to the retained earnings during the year, we're going to zero out that in entry I and entry D. Yeah, the income and dividends coming from the sub. And of course, the offset is again to reduce, trying to zero out at least most of the investment asset account on the records of the parent. And next entry, entry letter A. Entry letter A is to put in the excess costs we had paid in acquiring the assets of the sub, additional trademark, additional patent, that amount we couldn't had to plug in, that couldn't account for any identifiable asset, additional goodwill, and of course the reduction to the overvalued equipment. And again, the net is to get rid of that excess we had paid over the book value of the sub, the 200,000, by reducing the investment account, asset account on the books of the parent. Adjusting entry I is to eliminate the accrual of the by the parent of the sub's earnings. So that was the 100,000 profit coming from the sub, less the 7,000 net additional amortization. Yeah. So again, we're doing just the opposite, getting rid of that profit, debiting, putting back in investment and asset, reducing the asset account. Okay, it's getting smaller now. Yeah, that investment asset, and then getting rid of the dividend. Here we can see we're reducing, no, putting back the costs. So we're going the opposite way here, increasing that asset, investment asset on the books of the parent. But here, putting back that credit. Remember, you debited, yeah, when you declare dividends, you're putting back that amount in the records of the sub. And then last entry, I guess you can call this expense. I even forgot what the E stands for. I think it's expense. Anyway, amortization expense or depreciation expense. So the additional amortization debit for the patent, yeah, or copyright, but also reducing the depreciation on the equipment. So again, expense, right? Expense. And it nets out to $7,000 more expenses, yeah, for this entry E. So here on this screen is the ultimate goal, what we're trying to get to. Well, maybe not the financial statements, but the consolidated worksheet in which we can prepare the consolidated financial statement using this last adjusted trial balance column. Let me point out a couple numbers here. So when you look at the parent's investment in the sub here, this asset right here, you go across and it's zeroed out. Remember, that was one of the objectives because you cannot own yourself, right, in the consolidated group. And if you don't end up with a zero balance, you know one of these numbers is incorrect, or maybe you missed one of these lettered adjustment entries. Another thing here is the earnings from the sub reported by the parent. Remember, this is the 100,000 gross or really net income adjusted by 7,000 net amortization. Well, that gets eliminated. Now, why are we eliminating it? Because if you don't, you're double counting that profit, this profit of the sub, right? We eliminate it here, but now it's included, built into the revenue and expenses in the consolidated totals. Let me also point out this equity section here. If you look at the parents' numbers, these three right here, those three are the same on the consolidated group. And if not, something's wrong. Also, this whole worksheet is based upon the parent using the equity method during the year the parent now reporting the equity method of the subs numbers during the year, requiring us to prepare these specific journal entries here. Now, if you use the partial equity method or the initial value method, this consolidated total column is exactly the same, but because the parent had accounted for its sub slightly different during the year, it's going to require the entries here to be different, resulting in the same consolidated totals no matter which one of the three methods we're learning here in chapter 3. Okay, let's stop here for this part 1 video. So go ahead and continue into part 2, where we're going to look at the same companies, but the same company still using the equity method, but not for the first year of when we acquired the sub, but any subsequent year. Okay, so go ahead and continue into the next video.